Welcome everyone to the School of Personal Finance. My name is Rich McCormick, and in this video we're going to be talking about the 401k plan. You're going to learn everything that you really need to know to be successful with a 401k. A 401k plan is a retirement plan that is available to you through your employer. So the 401k was created back in the late 70s, early 80s, and it was created with the purpose of giving employees another way to save for their retirement. So back then, most companies offered a pension, you had Social Security, and then this 401k was an additional way that they could supplement their retirement and save money for the future. Fast forward to today, and things are very different. Most companies don't offer a pension. Social Security is a big question mark. So the 401k has become the primary way that we are going to save for our retirement. And it all falls on our shoulders. We're responsible for it. So we need to make sure that we are doing it the proper way and that we're taking advantage of all the benefits that it has to offer. So the two major reasons why people invest in a 401k are, number one, for the tax incentives. So the way that it works is any money that you decide to contribute into your 401k, you do not pay taxes on that money in the year that you make the contribution. So a very simple example is if you make $100,000 and you say, I'm going to contribute 10% of my salary, so I'm going to contribute $10,000 this year into my 401k, you will not pay taxes, federal and state taxes, on that $10,000. It's still subject to FICA taxes, to Social Security and Medicare taxes. But for that $10,000, it's going to go over into your 401k before the federal or state government get their hands on it. Now, once it goes over into the 401k through your paycheck, so it's payroll deducted, which is also nice because it's out of sight, out of mind. You can't get your grubby little hands on that money. It's going over there without you being able to touch it first. So once it gets over there, then you have investment options for how you want to invest that money for your future. And then much later on, once you're retired, the magic age is 59 and a half. So once you're older than 59 and a half and you decide that you want to start taking distributions or taking money out of your 401k, that is when you will pay the ordinary income tax on the distributions that you take in that year. So now the second reason why people contribute to a 401k is because most employers have some kind of match. And the match is basically free money. So the way a typical match might work, or a good match at least, would be is if your employer matched the first 6% of your contributions. So back to our example, if you make 100 grand, you're going to contribute 10% or $10,000 into your 401k. Your employer would match 6% or $6,000. So at the end of the year, you would have $16,000 that was contributed into your 401k account. $10,000 from you, $6,000 from the match. And one thing that you want to understand is if they have a vesting schedule. So most employers have some type of vesting schedule. And what that means is that the match that they contributed, when is that actually yours? If you were to leave the company, when could you take that with you? And a typical match might be like a 3-year cliff vesting. And what that means is after you've been employed there for 3 years, all of the matches are now yours. If you were to leave, you'd be able to roll that over to your new employer or to an IRA account. You've vested at that point. But if you were to leave, say within those 2 years, they contributed $10,000 into your 401k account and you left before you were vested, that money would not be yours. They would take that money back from you. So matches, they really are like free money, and it gives you a very big incentive to contribute into the 401k plan, at least up to the point that you're taking full advantage of the match. Your savings could really start to add up if you have a nice employer match that's available to you. So the next thing I wanted to hit on are the investment options. So once you make the contributions and the money goes into your 401k account, now you're faced with the decision, how do I want this money to be allocated? Where do I want to invest it? And most 401k plans will have, a pretty diverse menu of how that money could be invested. So it could go from ultra conservative, meaning like just a cash savings account, all the way to very aggressive, which could be like an emerging market type of stock fund and everything in between. So you want to make sure that you're investing in a way that is also comfortable for you, that matches your risk tolerance, because you don't want to be up at night worrying about the volatility of the markets inside of your 401k. And now some 401k plans, they have great options, low cost, big company names like Fidelity, Vanguard. They have index funds that are available. These things are all very important inside of your 401k. Some plans, they have terrible investment options and the expenses are through the roof. And you have to be able to distinguish between the two. So you want to look at the expense ratios for the funds. How much does it cost for you to actually invest in these funds? Because it could make thousands and thousands, up to hundreds of thousands of dollars difference by the time you're actually retired. So it's really important in your 401k to understand how the fees work. Money you contribute inside of your 401k, you have to look at it like it's long-term money. You know, you can't be putting money in there that you think, well, I might need that money in 5 years or 10 years. It is for retirement. It is for after you're age 59 and a half. It's very hard to get money out of a 401k once you've put it in there. There are ways to do it, but you typically end up paying either a penalty on it, you're going to pay taxes on it when you take it out. It's not a great thing to take early distributions from a 401k plan, even though it ends up being more common than we would like. So that money that goes in, you want it to be long term. You don't want to think that that's your emergency fund or that worst case scenario, I'll pull money out of my 401k. You don't want to look at it that way. It has to be money that you're putting away for a long period of time. Now, with that said, most 401k plans do allow loans against the 401k. So if you needed to borrow money, you could borrow your own money basically out of the 401k plan. And some plans will allow you to do it where you're paying yourself back interest. There's really no interest cost to you. You're basically paying yourself, a 4% interest rate back into your 401k. It's still not a great option, but it's one way that you could get money out of a 401k early. There are also some other ways that you could get it out, like for medical expenses, for hardships. There are other ways that you could get money out of 401ks, but you really want to look at that money as being your long-term retirement planning money. Another option that has become very popular over the last decade or so is the Roth 401k option. And I'm a big fan of this myself. So with a Roth 401k, you are able to put money in after tax, but then it will grow tax-free basically forever. So even when you take money out of your Roth 401k in retirement, you will not owe any taxes on it. Back to our previous example, if you make $100,000 and you say, I want to use all of my contributions and put them into the Roth 401k, so you do 10%, so $10,000 goes into your Roth 401k, you're still going to be taxed on $100,000. You get no tax break in the year that you make those contributions. But now that $10,000 that you put into the Roth, it's going to grow tax-free until you retire. And then once you start taking the money out in retirement, it'll be tax-free distributions. You won't owe any taxes on that money, which is nice. So now the next segment of the video are Rich's quick tips. So these are tips that I think are important where you could walk away from this video and actually go take action with some of this stuff. So tip number 1, invest in your 401k up to the match and then fund an IRA on your own. So what I mean by this is make contributions into your 401k so that you're taking full advantage of whatever match your employer offers. And then above and beyond that, contribute to either a Roth IRA or a traditional IRA. And the reason that I recommend people doing this is because in the IRA accounts, you have much more control. You could choose what company you open the IRA with. You could open it with Vanguard or with Betterment or Fidelity, a low-cost provider where you have more control over the investment options, where you're not forced to pick within their window of funds, which might not be the best funds that are out there. So invest to get the match, and then anything you want to contribute above and beyond that, open up an IRA and fund the IRA. If you're really going to save, go to the match, max out your IRA, and then go back to the 401k and max out the 401k. And it's worth me saying here, I haven't said it earlier, that the limits for the 401k in 2019, you could contribute up to $19,000 in your 401k. And if you're 50 years or older, you have a catch-up provision where you could contribute another $6,000 on top of that, so $25,000 total. But if you're younger than age 50, you could contribute $19,000 into your 401k account for 2019. All right, quick tip number 2. Go to your current 401k plan, look through the funds, and rank them by expense ratio. So anything that has an expense ratio over like 0.75, 0.75%, you should immediately put to the side. You really want funds that have expense ratios, in that 20 basis points and below ballpark. So those are going to be low-cost index funds, and hopefully your 401k has some of those available, like an S&P 500 fund, or a small cap value fund, or a large cap fund, or an international fund. But you want them to be low-cost index funds because it makes all the difference in the world as you look over a very long period of time. So rank them by expense ratio and take the 10 lowest ones that you see and try to create your portfolio from that. So quick tip number 3, just invest in a target date retirement fund. So if your 401k plan has good target date retirement funds available to you, just choose that as your investment option. It's only one fund. It's what we call a fund of funds. They put together a nice allocation, a portfolio for you in one fund, and they correspond it to the year closest to when you're looking to retire. So for example, if you're looking to retire somewhere around the year 2050, you can put all your contributions in the 2050 target date retirement fund. And then as you get older and as you get closer to retirement, that fund will go from being more aggressive to gradually getting more conservative as you approach retirement. A few things you want to be careful with, or you want to make sure that it's still a low-cost option. You don't want to pay up just to have the target retirement date funds as your option to invest in. If it's much higher cost than you putting together a few index funds, then I don't suggest you do that. But if you have good target date retirement fund selections available to you, it's just a simple way for you to invest and not worry about it and just go with it. Quick tip number 4 is tax diversification. So I spoke about the traditional 401k and the Roth 401k and the difference in the way that the money is taxed. So what I love to recommend to people is to invest in both. You're able to put some contributions in the traditional and some in the Roth. So if you're going to contribute $10,000, then maybe you put 5 in the traditional 401k and 5 in the Roth 401k. This gives you flexibility. So when you retire, you could decide, depending on each year by year, what your tax situation is. If you have a lot of income one year, you could say, you know what, I'm going to take some money from the Roth because I won't have to pay taxes on that at a high tax rate. If you have very low income in one year, then you could say, you know what, I'm going to pull some money out of the traditional 401k because it's going to be taxed at a lower tax rate. And another thing to keep in mind is any match from your employer, that's going to go into the traditional 401k side. So even if you're contributing all of your money into the Roth, the match piece of that is going to go into the traditional 401k because you haven't paid taxes on that money, so you're going to have to pay taxes on it when you take it out in retirement. And then my 5th and final quick tip is to invest outside of your 401k. So you do not want your only investment in this world to be your 401k plan because that's for retirement. That's for a long way out. You want to have some money that's going to be invested for that mid-period of your life. So if you're young, if you're in your 20s and your 30s and you're just starting out, yes, you want to make sure that you're taking advantage of that match and that you're saving for retirement. But there's a big window of time when, maybe you're going to have kids that are going to go to college one day, or maybe you're going to want to, be able to take nice vacations 10 years from now, or you're going to want to save for a house 10 years from now, or whatever it may be. You just don't know what life is going to throw at you. So after helping, thousands of people in my life with their personal finances, I have seen so many times where people are pulling money out of their 401k early because they have no other money. So they live paycheck to paycheck. They squeeze everything into their budgeting. All their money goes, and they include the 401k in that. So they contribute to their 401k. They're making sure they're saving for retirement, but they have no other savings, and everything else is squeezed so tight that when they have an emergency, they have nowhere else to turn. And I get that phone call, I need to take money out of my 401k account. I have nowhere else to turn. And it's not a good way to structure things. So contribute for retirement, contribute to your 401k, but at the same time, it's good to invest outside of the 401k, even if it's a brokerage account. It's great to fund an emergency fund first and then invest in the brokerage account and also the 401k. But it's good to be diversified, not only with your investments, but with the tax allocation of those investments, with money that's been invested after tax, along with the pre-tax stuff. So you want to make sure that you have all stages of your life, covered, and that you're working towards goals for each individual stage, as you kind of get older. All right, everyone, that's it for 401k plans. Hopefully you found that helpful. If you haven't already, please go to schoolofpersonalfinance.com. Check out all the content I have on there. Subscribe to my email list. I would love if you would send me an email, give me some topics that you would like me to do videos on. Please subscribe to my YouTube channel. I will see you again soon. Thanks.